Hello everyone, welcome to the second of our ACCA P2 lecture recaps. This was a continuation of our groups. Remember that you can get this and all of the full course lectures on our website, and you can download for free all of our mind maps as a PDF. So that's on the website shown. So where did we start? Well, we said that IFRS 3 contains details on how the acquirer recognises and measures in its financial statements the identifiable assets acquired, the liabilities assumed, and the non-controlling interest in the acquiree. So it sets out how we are going to recognise and measure in the group accounts the identifiable assets acquired, the liabilities that have been assumed, and the non-controlling interest in the acquiree or the subsidiary. It also sets out how we should recognise and measure our goodwill. So how do we recognise and measure goodwill or a gain from what's called a bargain purchase, effectively negative goodwill? So what do we do with that? Lastly, it determines the disclosures required for all of this. We then looked at the core principle. If we were to sum up IFRS 3, we can say that assets and liabilities acquired are measured at fair value at acquisition. So assets and liabilities acquired measured at fair value at acquisition. IFRS 3 also sets out the acquisition method, and you'll see that broadly speaking this is the method by which we go through and consolidate our accounts. So the acquisition method says first of all identify the acquirer. So identify the parent, and that's the first step that we undertake as well. Determine the acquisition date, because of course we have to determine the fair value of the assets and liabilities at that date, so we need to know what that date is. We then need to recognise and measure those assets that we've acquired, the liabilities that we've taken on, and the non-controlling interest in the subsidiary. We also then need to measure our goodwill or the bargain purchase. So all of this is called the acquisition method, and this is the method that we will go through in our goodwill workings and in our consolidation workings to prepare our group accounts. So looking at assets and liabilities, IFRS 3 says that we need to recognise separately the assets, the liabilities, and the non-controlling interest, and it tells us how to do that. First of all, they must meet the definitions in the framework. So the assets and liabilities must meet the definitions of those assets and liabilities in the framework. And they also must be part of the business combination transaction. They must form part of the transaction to purchase the subsidiary. You may recognise previously unrecognised assets, for example, internally generated brand names. If you think about the standard on intangible assets, IAS 38, what it says is if you generate an intangible asset internally, such as a brand name, you may not be able to actually capitalize that and hold it as an asset on your statement of financial position. But IFRS 3 says that you can recognize previously unrecognized intangible assets. Measurement, how do we measure? Well, fair value at acquisition, as we've already said. We're going to do that for our assets and for our liabilities. The non-controlling interest, we have two methods we can use to measure the non-controlling interest. We can either measure it at fair value, and that's using share price or valuation, and that will lead to our gross goodwill. That allocates some goodwill to the non-controlling interest, which we'll meet in our goodwill lecture. Or we can use the proportionate share of net assets, and that doesn't allocate any goodwill to the non-controlling interest. But you do have a choice when you're preparing the financial statements as to which one you'll use. In the exam, you'll use the one that the examiner tells you to. Contingent liabilities, also under IFRS 3, we can recognise contingent liabilities on acquisition. So you recognise contingent liabilities on acquisition. So if the subsidiary, say, has a contingent liability disclosed in its financial statements but hasn't recognised it, we do recognise that on acquisition, and we'll recognise it if it is a present obligation and you can have a reliable measure of it. There is no need for it to be probable. So for it to be recognised in the single entity's financial statements, it would need to be probable, but not under IFRS 3 for a consolidation. So if there is a contingent liability, we'll recognise it on acquisition if we have a present obligation and a reliable measure, not required to be probable. Goodwill, well, we know that this is the purchase consideration, which will be measured at fair value, and includes contingent consideration, which we'll meet in our consideration lecture. It doesn't include the costs of acquisition. These are expensed. So costs of acquisition are expensed. So we have the consideration plus the non-controlling interest plus the fair value of any previously held interest, which will make more sense when we come to that lecture, less the fair value of identifiable assets, and that will give us our goodwill. So when you're doing the workings on goodwill, think back to IFRS 3, that's where they're coming from. A bargain purchase, remember this is negative goodwill, so if the fair value of the net assets is more than the rest combined, i.e. your consideration, non-controlling interest and your previous interest, so the fair value of net assets is more than all of that, well then you'll recognise that gain in the profit or loss. So that will be a gain, and you recognise that immediately in profit or loss, you don't capitalise it. Disclosure requirements then. Disclosure requirements under IFRS 3, we have the name and description of the acquiree, we have the acquisition date, the percentage that's been acquired, also the reasons for the combination. So the reasons for the combination, so the goodwill comp will be included there. Contingent consideration details, so if there is contingent consideration, that will be disclosed. If there's been a bargain purchase, that needs to be disclosed, and details if there's been an acquisition in stages. So that was our lecture 2, a continuation of groups looking at IFRS 3.